Okay, hello everyone. Hello, Futex traders. To the wider investment community, those that listen to us every week. Um, well, Happy New Year, first and foremost. This is my very first video of the year. And what I wanted to go through, instead of going through the traditional weekly trading roadmap that I usually do, I wanted to do somewhat of a yearly technical trading roadmap. I'll go through a few potential themes that I think might arise or still be around from the previous year, and some themes that we should potentially be looking at in the upcoming year. But also, I'm going to look at quite a few different markets and see how they've actually wrapped up the year last year, how they've kind of ended, what they look like in terms of market structure, and potentially what implications that may have on trading those markets this year. So first and foremost, what I'm going to go through is just potentially some of the themes that we've seen last year, what we could see this year again. So the very first one that I've noted, obviously, is the Grexit situation, which is a very big part and major part in trading come between late spring and early summer. There's a lot of tensions around Greece, and we've kind of kicked the can down the road with that, at the moment. And even the way things have played out so far, I think in a recent poll that I've read, 60% of Greeks now feel as if Greece will actually exit the Eurozone. So this could be something that resurfaces again. It has not gone away for many years, and it's been there. It's been an issue that people have, that the Eurozone has had to constantly confront. So I think this could potentially arise again, and it could finally be the last straw. So, well, that tension could be really quite important to pay attention to, and just listen in to see if anything just sparks up overnight. We might get some moves, and then you'll start realizing that this is coming into play again. And for the minute, this is still kind of on the back burner. The next thing are the Chinese devaluations. Now that obviously comes with the territory of potentially China having a somewhat hard landing. So overall, over the last 7 to 8 years, well, really since the financial crisis struck, most of the developed countries have been boding fairly well. They've been obviously doing quite poorly and recovering, but it's the emerging markets that I was trying to say actually that have been boding fairly well. And one of those is China. And in recent times, the last year or so, we've been seeing China start to slow down a little bit. That big giant that is China, the big manufacturing giant, the construction giant, is slowing down. And with it, we've seen also commodities, a bubble burst in commodities as well. And the Chinese have began to start devaluing the currency quite aggressively. So we want to see if this is potentially going to continue in the year ahead in 2016. Now, if they do continue devaluing the currency, what implications is that going to have on our other markets that we're trading potentially? If we're trading, let's say, the European equity markets, for those companies that are exporting heavily to China, some of the automakers, for example, that export heavily to China, they're going to get hit big time because the Chinese buying power is going to get reduced as their currency becomes weaker. So these implications are going to be quite important. Last time we saw the Chinese devalue their currency quite aggressively, we saw a huge dip in the equity markets, especially the S&P 500, the Euro stocks, the DAX. They took a really quick and violent move to the downside. It was around the August period. It was very much liquidity. Obviously, we'll have a lot more liquidity now for the market participants to play with. But on the same token, it's something to pay attention to. That was what sparked the last big sell-off. So if we see a continuation in this trend, this could pan out to be something quite interesting for us to trade on an intraday or weekly basis. Now, obviously, the big event that took place in late last year was the Fed actually hiked their interest rates by 25 basis points. So currently the target range is between 25 basis points and 50 basis points, and the Fed funds rate is fixing it around 34 basis points. I think actually on the 29th I read today, it actually fixed a lot lower, actually below the target range at 20 basis points, but that might have been just due to some liquidity issues. For whatever reason, just pay attention to what the Fed is doing this year, because it's very important to note if they're going to continue hiking, or if we do get heightened volatility in the market if they're forced to cut. In my opinion, I think they probably have hiked a little bit too late in the cycle. If they wanted to hike, they probably should have hiked maybe 2-3 years ago, and now they've just kind of hiked for reasons of credibility. And as such, if we do see a lot of volatility and we do see the equity start to take a violent dip, some stress in the bond markets or the corporate bond markets, as we'll go through in a second, maybe they might get forced to cut again, back down. So it's really quite important to pay attention to this if they're going to continue hiking, because if they continue hiking, then the rest of the trends that we've been seeing might actually continue playing out. They're a big driving force in the global liquidity, and as they're hiking, liquidity is starting to dry up. So remember that liquidity will start drying up as they start hiking. Now, the next theme that could potentially continue is this commodities bubble burst that we saw in 2014 and 2015. So late 2014 and the whole of 2015, we've seen the commodities come under severe. We saw severe stress in these markets. Let me just try and make this a little bit thinner. Yeah, so severe stress in those markets, and we've seen that especially in the oil market. Gold's been particularly weak, and copper. Copper hasn't had many headlines, but I think copper, as we'll take a look in the structures, could potentially become one that grabs the headlines if this theme continues. Now, is that going to continue, or have we seen potentially a bit of a exhaustion in that trend? Now, that really does depend if we do continue to see a slowdown in the emerging markets. If China does continue to slow down, I would suspect that not only due to supply concern, but now also due to demand concerns, we might actually get a lot more breadth in the weakness in the commodities. So far, we have seen oil basically underperforming most of the commodities, but we'll take a look at some of those market structures in a little bit. Like I said before, I'm really trying to focus on the technical side. I can't foresee, I'm not a wizard, so I can't really foresee what the main event-driven risks of this year are, but just taking a look at some of the themes for now. So moving on, emerging markets, they've had a lot of strain in recent years. Has that trend exhausted, or will it continue? We've seen a little bit of an exhaustion, I think, or euphoric, not exhaustion, but more of a euphoric move in some of these markets. So potentially we might have seen a bit of a low, potentially just because of how quickly they've moved in recent times. But again, that's going to highly depend on the Fed. If they continue to hike, we might get some more hot money flowing out of those emerging markets and into the more developed countries, i.e. the states, where rates are beginning to rise. Now remember, a lot of these emerging markets over the years have built a lot of debt during this cycle. They've taken out that debt from the United States, so they've borrowed in dollars, and as the dollar is actually increasing in value, their debt is increasing. So that doesn't really bode well for the emerging markets, and that's why hot money potentially moving out of those countries and moving into some of the more developed countries. So keep in mind, if that trend does continue, it has been moving, it has been a theme of the last 2 years. It's not new news, it's been there for a while, so potentially could have exhausted slightly. And we'll take a look at some of those structures to see if we could see anything to keep an eye on in the year ahead. Another theme it's slightly come into our focus in the latter end of last year has been ETFs, and particularly leveraged ETFs. Now, there's a lot of different ETFs. There's hundreds, if not thousands, of ETFs out there, but there's obviously some more notable ones that people pay attention to. One that's come into focus recently has been this HYG ticker, and it looks at the junk bonds or mostly the high yield corporate bond space in the States, the US high yield corporate bond, and the ETFs, the iShares iBoxx high yield corporate bond ETF. And this HIG ticker has come under particular stress in the latter end of last year. Now, that could potentially be uh, you know, those that have taken positions in those um, high yield corporate bonds are potentially seeing those fundamentals deteriorate. If it's not the fundamentals, it could potentially be due to the central bank. The Fed has started to hike rates, and thus they're starting to pull their money out. Usually, what you see before an equity market downturn, the bond space or the high yield corporate bond space actually gets hit first. So the bond markets lead the way. The people start pulling their money out of the high yield bond market first, and then you see the equity markets begin to feel the stress. So do keep an eye on this, because this could be a theme that develops in the next year, in this year ahead. I just wanted to point this out for those of you that haven't paid attention to this. I know that a few of the more experienced guys, even just from following people on Twitter and seeing what they're talking about, they have pointed this ticker out already. But for those that aren't aware of it, just pay attention to what the high yield bond market's doing, because there's particular issues with the liquidity, the illiquidity, or should I say, in the high yield corporate bond market. The ETFs are very liquid. There's a common misconception. The actual ETFs are extremely liquid. In fact, this HYG ticker is one of the most liquid markets in the world. However, it's the underlying market that's actually quite illiquid. So you do get quite interesting dynamics between the two. You might start getting severe premiums and discounts between those ETFs and the underlying. But in any case, just watch out, because any stress in that market domain might actually transfer into the rest of the market, or the wider market that we trade. Cool. So these are potentially some of the themes, and we'll see as they develop. You'll hear me go through in my weekly trading roadmaps what we're looking at for the week ahead. So as and when they develop, I'll be going through them, and I'll be highlighting what we're going to be looking at, and at what times during the week we should be looking at them, and how we should manage our money around them. But for now, these are just a few little pointers. I don't want to go through too much depth. I could speak on these matters for hours, if not days. Really, they're huge subjects in and of themselves. But I just wanted to highlight them potentially. For those that are trading this year, some things to take a look at in the year ahead. So, and the last thing I didn't mention, actually, that didn't bullet point, actually, in late 2016, we're actually going to have the U.S. elections. So the elections are going to be something to pay attention to, and we want to start figuring out how the market perceives each candidate. Going into each election, certain candidates with either their fiscal views or how they see monetary policy playing out. They don't really have that much of a say in it, but it's more how they move Congress, and how they what their views in general on how easy the government should be with regards to spending. In that respect, once we start figuring out how the market's reacting to each and every candidate, whether it be Hillary Clinton or Donald Trump, it seems like they're the frontliners at the minute. We want to see how the market starts paying attention to these two, and the election period for some of these larger countries like the U.S., the U.K., Germany, Japan. These countries, they affect their local markets quite quite a lot. So it's important to stay tuned to see how these play out. And like I said, you want to pay attention to how the markets take the polls and how they're performing thus far. Right, so that's pretty much what I want to go through for that. Let's just take a look at some of the technicals now. We've got quite a bit to go through, so try and keep try and keep up with me, because there's a lot to go through, obviously. So I'm going to go through the bonds, then I'm going to go through a few spreads in the bond space, and then I'm going to look at the FX equities and finish off with the commodities. So quite a few markets to go through. The first market that I wanted to just quickly glance over, one of my main markets, is the German Bund. Now it's a lot easier to look on a longer time frame in yield terms rather than on a price chart. The price chart, they do help, but they do change a lot, because due to continuation, if you're looking at the futures market, they do change. So the price levels might change, but the yield levels, they don't change. If you look at a yield chart, what was a level yesterday will be a level next week, and hopefully in 2 weeks time from now. So these levels don't change due to the futures expiring and continuation and whatnot. So we'll take a look at the yields in that respect. So currently, the structure of the German bond market is quite interesting. Obviously we've been in a very big downtrend in yields overall for the last, I don't know how many decades it's been. If you look at a yearly chart, obviously it can't go that far back, but you can see, we've been steadily moving down in yields. As far as we can see, this is going back to about 1990. So this has just been steadily moving down. Now, what's interesting is, obviously the last time we had a green candle was actually in 2013, as you can see in here, but that green candle didn't really go far. It was an inside year, in fact, and when we broke that inside year, we actually saw a pretty big down move in yields in 2014. Now 2015 is quite interesting because we've actually left a doji. So we've left a doji. We've closed back inside the previous yearly range. So we attempted to move lower, and actually what we've done, so we've attempted to move down in yield, and actually what we've done is actually close back inside the range of the previous year. I don't usually look at yearly charts, but I think if there's one time you're gonna look at yearly charts, it's probably best to look at them at the beginning of the year. Just look at what happened the previous year, sum it up, see what we're looking at effectively, just to give you a better picture of what we did after all that trading, after all those days of analysis on the weeklies, the monthlies, the 5-minute charts that we looked at, as many charts that we looked at, it all summed up to this candle. After all of that trading, this is what the summation was. We've tried to move lower in yield. We tried to move higher in yield. Overall, we closed back inside the range of the previous year. Now, is that a bullish signal for yields, i.e. bearish signal for price? I can't quite say that at the minute because the fundamentals still point for lower yields. But that could change. Inflation could change. We might see all of a sudden a very big spark in inflation, in which case that could be another theme that I didn't mention before. But potentially with oil prices so low, we might start getting the consumer go crazy, and then we might get a lot more inflation. If we get inflation, longer end bonds are going to sell off. So that could be a theme. But what we're seeing right now technically is that the market's actually closed back inside the previous year's range. Looking just at a monthly chart, you can tell where our important inflection points are effectively at this 42 basis point mark, which you can see right in here. So that 42 basis point mark, you can see those monthly lows there are really quite important. If we are to hold lower prices and basically higher yields, we want the market to hold above this 42 basis point mark. It's not only these monthly lows in here, but it's this monthly high in here. So I'm very I'm going to be paying a lot of attention to this yield level, potentially, if we get there. Effectively, if we start closing below this level, then we're looking at potentially testing lower for that all-time low at the 5 basis point mark. Really quite low there. So that's basically what we're looking at now in the German yields, in the German 10-year Bund yields. That's the level that I'm looking at to the downside. Now, potentially, if we can hold above here, just pay attention. We've got this bigger wedge formation in here, this triangular wedge formation here. If we do start breaking, taking out some of these highs in here, that could potentially give us some impetus for a move higher to test up in these areas. Now, along these areas, we have some interesting resistance levels in terms of yield. We've got the basically the 1% mark just above there, the 1.06 mark really in here, and then just above at the 1.12% mark, which is these basically these yearly lows, as you can see, the 2012 lows in here and the 2013 lows. So this whole range in here is really quite interesting. We've got this price-based formation which held us when we came up there. We didn't quite get up to that level, but that's essentially the level we need to keep an eye on. If we can get back above, start holding price in there, well then potentially we might get a move to test the other side of this range at 1.7%, the 1.7% mark. As you can see, the upper end of that price base. So this is technically how this market's set up for this year. This is a monthly chart that I'm showing you at the minute. So, this is what we want to pay attention to. We've had potentially, if we are looking at higher yields, this has been our move in here, our wave one. This is, well, let me just delete all this. This has potentially been our wave one. This potentially has been our wave two. If we start moving higher again, we might start seeing wave three. And as we know, wave three is usually the most violent and the longest of all waves. So if we do get wave three, you would potentially see a much bigger wave than what we just saw now in wave one. So we could see something of the order like that, which would give us something that looks technically quite sound, I'd say. And then obviously if we do pare back a bit, that would be our wave four, and then our final wave five. Now that is a scenario. I'm not saying it will happen, but that is a potential scenario. Just watch out to how this is structured at the minute. I'm not particularly super bearish on the bunds, but I do feel they do have potential. Given the way the market's structured at the minute. So that is our bund structure for last year and potentially for this year. Moving over to the US 10-year T-notes, which really there's not much to say. I just wanted to point out what they look like. Also point out a yearly trend line that I've observed going back a very, very long time. So if we just scrunch this up, this is a monthly chart of the 10-year T-note. You can see this line in here that I've put in, this red line that starts back in about 1987 really, and connects here with this line here just below 2000. This has basically been the overarching move in bonds, or at least in core bonds, have been to the downside. Rates have been moving down for 30 years really, 30, 40 years now, just literally in a straight line down. So this is really the line that I'm paying attention to, this red line that you can see, because that is basically showing me that the trend to the downside is prevailing and it's going to stay. Now, if we do potentially get above, break this red trend line and get above this 2.5% mark, which has been a very interesting level throughout the years. This whole level here has been quite an interesting level, the 2.5% mark. If we can get above here, hold this, then that could indicate a potential change in trend. We have not seen that yet, and many times before we've been saying watch out, watch out, watch out, but we haven't seen the break yet. When we see the break, and if we do see the break, then we can start building scenarios of how we're going to trade it. Until then, until such time, the market is subdued, low yields, and we're range bound. I cannot stress that enough. Really, just taking a look at this chart, you'll see if we scrunch this up to, well, actually just open it up a little bit and take a look at what it looks like on a smaller time frame. You can see we're fairly range bound in this range in here, between 2.5% down to about 1.6%. So that's currently how the market's structured. In the shorter term, obviously we do have this bit of a wedge formation. It's nothing really crazy. I don't really like the downside trend line too much. It does have two touches, but I do prefer this upper one that has 1, 2, 3, 4 touches. I think potentially if this breaks to the upside, then we might see a test of this red multi-year trend line that I just pointed out to you guys. So just pay attention to that. That could be something that plays out potentially in the year ahead if they continue to raise rates, and if we do actually see some sort of inflation. We haven't really seen that much inflation. I mean, core inflation seems to be moving higher, but obviously with oil being so low, that's obviously affected the the nominal CPI that we usually look at. So that is our German and US 10-year. I'm not going to go through the UK bonds. This is not market. I do look at them, but there's a lot of other markets I'd rather look at the minute. So I'm just going to quickly look at just two spreads before I move over to the FX markets. Now, the first spread, and we're looking at bond spreads, bond spreads now. The first spread I want to look at is the Schatz versus, sorry, not the Schatz, the US 2-year versus the 30-year. And this is a market we've looked at in the beginning of last year. We did point this out that potentially if the Fed started to hike rates, we would see further flattening. So coming to late 2014, around this period in here, so moving up to this around here, this is where we pointed out that we could see some flattening. We did see some flattening coming into 2015, but then we saw quite an aggressive steepening again as those Fed hike expectations got pulled back, and they kept pulling back, or sorry, pushed forward. So we kept pushing those rate hike expectations forward until finally we did hike rates, or we started believing that they would hike rates, and we started flattening again. And then we saw obviously some further flattening once they actually did hike rates. So potentially now we're looking at a market that could continue flattening. Now the theme in flattening would only really work if inflation does stay subdued and growth expectations stay subdued, because the longer end of the yield curve represents those two aspects that I just mentioned. So if growth and inflation is subdued, the longer end of the curve is going to outperform the shorter end of the curve, which is more sensitive to the interest rate hikes. So that's how you get the flattening of the curve. Now, if we look into history, we could see in previous hiking cycles in 1994, for example, when they started hiking rates, we saw a very aggressive flattening to the downside. Again, in 1997, we saw a bit of flattening in there in that hiking cycle. Then again, coming into 2000, we saw some very aggressive flattening in there. We actually inverted. So this is our 0%. So this actually, the 2-year yield was actually higher for all of this period. It was higher than the 30-year yield. So that was an inverted yield curve. So that was a pretty interesting dynamic. And usually when you get an inverted yield curve, that means that the market's basically screaming out that we're getting, there's potentially a recession or a crisis on the way. Last time we saw, a flat or slightly inverted yield curve was in 2006, 2007, and then we obviously had the financial crisis in 2008, which you could see the insane steepening that we saw there. Again, in these years, 2004, 2005, I believe, or was it, I can't remember the years exactly when they started hiking, but it was definitely in this period. This was part of a hiking cycle again. So the point I'm trying to make is, if we continue to see the hiking cycle, this flattening could be very, very aggressive if we do continue to see subdued inflation expectations. In that case, the levels we're looking at is this 1.786% there and 1.699, basically the 1.7% level. Once we breach through this area in here, once we start breaching through this area in here, keep an eye out, because if we start closing below these levels, there's nothing really holding us back to trade down to at least the 1.2% level, which is really, we had a few, few resistances in the past. Doesn't mean we'll stop there, but just bear in mind it could be a potential level. If we don't hold there and we continue, this could be, again, a very rapid move to the downside, indicating potentially some financial stress in the future. So that is how we're shaping up at the minute in this. If we can't, now this is a different scenario, if we can't break this to the downside and we actually come back inside, for whatever reason, let's say we do test here and we can't break it, and then we start seeing a rapid rise in inflation for whatever reason, then we might actually start seeing quite a rapid reversal or a steepening in place. So these are scenarios that potentially could play out in 2016, depending obviously on the inflation environment ahead, in the 2s versus the 30s part of the curve in the US. Now, looking at the Schatz versus the 2-year T-note spread, so something really quickly that I wanted to point out, that has obviously been exploding in recent times, since obviously we've had the expectation of a rate hike. Obviously we did get the rate hike, and this has been, exploding. Obviously the 2-year yield has actually been moving a lot higher than the 2-year yield in Europe. Obviously the 2-year yield in Europe has been getting slammed because the ECB has been extending QE and bolstering their QE program as opposed to the Fed, which is on a tightening cycle. So that 2-year part of the curve has actually been the two-year spread in the U.S. versus Germany has actually started to move aggressively to the upside. Now, if we take a look at how this market's played out in the past, just to point out what this market looks like cyclically. So this is how the market's played out in the past. Obviously, we've had times of financial stress and a couple of very interesting spikes, but nonetheless, the structure that I'm paying attention to is this structure that you can see in here, this little price formation that you can see, with the lower end being a 1.424% and the 1.9% level just above there, which has seen quite a few inflection points. Now we've actually come into that level, and if you saw on the slightly closer viewpoint, we actually came into this level pretty much to the tick and actually started coming off slightly from there. So really what I'm looking for is if we can get back above here and hold in this price region in here, then we could see scope for this to come back into this value area, trade through all of it to the other side of that range at 1.9, which would imply further strength in the shats and underperformance in the 2-year Tino. I would assume for this to play out, we would need still some further aggressive hiking out of the US for this to take place. Right, so those are the two spreads I wanted to show you for those that don't trade them. Anyway, I didn't really mean to bore you, but it's something to keep an eye on because this does affect the bond markets, especially if you're trading the bond markets. It's important to know where these inflection points are. It will affect your trading, I guarantee you. If we take a look at the FX markets now, we've got quite a few to go through. Just to start off with, we've got the Euro USD, which obviously in 2015 slightly continued its move to the downside. I wouldn't say it moved much. It did the majority of its move early on in the year. So this was our opening price here at 1.2098, right in there. That was our initial move. The first month, we made another move to the downside, and then we basically ranged for the rest of the year, closing somewhat lower. So this was net what we did. From this point down, we moved down to this point that you can see in here. Now, obviously, the market is still technically bearish, fundamentally also bearish. I would not change that viewpoint, but until such time as we can break and hold below this 1.0456 level, which is that low that we left of 2015, really we could see this market trade within this range until then. But like I said before, longer term, this does still look bearish. Now, obviously, a lot of market participants are looking at parity as the next target. If we do break down below there, parity actually looking like a pretty interesting level. As you can see, parity held us back in the 80s. Obviously, we didn't have the euro, but we did have, at the time, I believe this was trading against the Deutschmark. So that was our, point of reference back then. But there's an interesting inflection point nonetheless at this parity level. This whole area really looks interesting. So around that area, when we get there, could provide us with a bit of support. Through there, obviously, the next real level that I'm looking at is this 0.9601. Monthly highs in there, double monthly lows in there. And obviously, if we get through there and we start getting into this value area down here, then we're looking at potentially a much wider move down to this 0.8225, which is the lows in 2000. So that's basically how we're looking. Obviously, all levels to the upside still hold. The level to the upside that we couldn't manage to break above this year when we did have a rally was this 1.1638. I know we did get through it, but really that was the level that, these levels in here were really the levels I was looking at. These pretty important monthly and yearly lows. As you can see, this whole area, this whole spatter of lows is really quite important for the market. And overall, this whole value area on the top here is a very big overarching resistance in the market. So if the market did want to rally and make a move back up to here, it would really have to contend with a lot, and would have to do a lot of work before it could actually make much, make much ground to the upside, because those violent moves that we saw to the upside this year really were due to shorts getting squeezed quite violently due to certain event-driven risks. Now, moving on to the pound, the cable as we call it. This is our monthly chart. The cable, as you can see, since the fall that we had in 2008 is in here. This is our move to the downside. We've basically been in this range, as you can see in here, this whole boxed range region, which is obviously quite interesting for maybe a longer term swing trader, but for us, intraday / short term swing traders, it can be a bit frustrating trading this because it hasn't really done that much this year all in all. As you can see, this year really we started around in here, if I'm not mistaken. Let me just pull that candle up. I think it was this candle in here. So yep, nope, that's the one. Yeah, that's the one. This is the candle in here that we started on. We had a short move to the downside, came back up, failed to hold a bit, and then we've rolled back over again. So overall on the year, actually, we've had a pretty weak year. If we take a look at this chart on a yearly time frame, you'll see what I mean. And in fact, I think on a yearly time frame, it actually does look quite a bit more bearish in comparison. So if we take a look at the way that looks, we've tried to make a move to the upside, as you can see in here, found our resistance around this 1.7218 level, turned over. The market tried again to make some headway to the upside. Again, we've closed low on the year. So overall, the pound's been pretty weak this year. So in fact, the way this is trading, it's relatively quite interesting. This could actually have some scope to the downside if we can start holding these prices below these levels. So if we just try and get that back up to a monthly, so we can point out some of these levels. So our key pivots, really, we just want to look at the key pivots because structurally, we're still relatively contained in this area. We've come into this support region, this trend line, as you can see in here. We've kind of dipped through it actually today. But if we can hold this level, this area in here, maybe we have got some scope to the upside. If we break and actually hold below this low at 145.49, well, then we actually start getting some scope for some real moves to the downside, where we actually have, as you can see, just open this up a little bit. We've got a few interesting levels here at 140.63. We've got yearly lows in there. We've got a couple of monthly lows in there. I like the fact that it's been somewhat of a base in here. So if we get back to this level, I'm actually quite liking this area in here for an initial play. And obviously through there, we've got the 134.98, which is the low that we made in 2009, I believe, or just after, at the beginning of that year. So that's really what we're looking at in terms of structure. All levels to the upside still remain, but if we do actually start breaking down here, potentially, then we could start seeing some further downside in this market to test levels that we haven't hit for a very, very long time. Obviously below that area, there's really not much to go through really, with I'd say the all-time low in this is at 105.2. So this is a pretty interesting little dynamic. The way we've structured here, we've been held in this area for a very, very long time. This actually could be a market with potential to move. I think this structure, this is kind of how oil started off. Oil looked a very similar structure. It had a wedge. Obviously the wedge looked a bit different. It was to the upside. We had a move up into it, then down, then we had this giant wedge formation, and then we tested lower again. So that's how oil looked at the beginning. But nonetheless, this already has a bearish structure coming into it with a sort of wedge formation. If we can start breaking lower, we might start seeing some unraveling of some long positions that are built over the years. So that's how the pound is looking on a longer time frame basis. Generally, just to take a look first and foremost, before we start going through some of the other pairs, take a look at the dollar. So looking at the dollar, obviously, we can see the market's been in, obviously, broke out of this giant wedge formation back in 2014. We came up to this level. We've been ranging between this level of 100, about the 100 mark, 139 mark. We've held just above this 92.29, a level that we've been talking about for a very long time. This plateau in here that every time we come down here, we seem to find buyers, and we're moving back up to the upside. Now, the way this is structured at the minute, really, we want to see if the market can get back above this $100 mark. If we get back above 100, then we're making headway up to this potentially nice pivot at 102 to 103.54 area. Overall, the market still looks bullish, but we'll have to wait and see how the Fed, if the Fed does continue to hike. If it does, we could see potentially more upside in this pair, which is obviously going to affect a lot of the other pairs that we're going to talk about. If we quickly go through some of the other ones, I don't want to spend too much on the ones that don't have any structure and spend more time on the ones that do have structure. So we look at first very quickly the Aussie dollar. We mentioned early on last year we had this very big head and shoulders pattern, our left shoulder in here, our head in here, and our right shoulder in here, which broke in 2014. We've pretty much done, I'd say, a large majority of the target, but we probably still have a little bit more to go. At the minute, this market still looks very bearish. This is our monthly chart. We've got a slight wedge formation just building in here. As you can see, if we can start taking out some of these lows, these monthly lows, potentially we might see a test back down to this 0.6893 level before coming into potentially some levels that we haven't traded really back since 2008, 2009, down at the 0.6 level down below, as you can see there. So overall, the market's still looking fairly, I'd say fairly bearish as it stands right now. In the longer time context, you can't really shy away too much from that. Obviously, that can change. If it were to change, you would want to see the market start to hold previous resistance levels, hold above previous resistance levels, such as the 0.755 level. If we can break this wedge and actually hold above it, that would give us some scope to start testing higher. But until such time, the monthly structure is actually looking fairly bearish. Likewise, if we take a look at the Kiwi, not much to point out. Very similar type of structure. We had a topping formation that formed in here. So this was our double top. We had this trend line which broke and then led to some further weakness to the downside. The key level that we're looking at now in the monthlies is this 0.6897. As you can see, double monthly high in there, which really is holding us at the minute. If we can hold this level for the time being, then potentially we could see it move back down to 0.6233 level. But really, the level I'm looking at potentially, if we can get below this 0.6233 level, is this 0.5909 level, which you can see is a very big level back in 2004 and in 2006. And I believe even further back than that, if we just take a look, there we go. Even going back to about 1985, 86, 87, you got nice double top highs in there as well. So this level is pretty enormous. And one that I'm going to be paying attention to if we get there. I'll definitely be looking to trade that, even if it's short term or on a swing time frame basis. I'd say it's quite important to take a look at and potentially keep it in your trade plan. Now moving over to the CAD. Just take a quick drink of water because I've been talking for quite a while now. Looking at the CAD, we've seen quite a bit of weakness in the CAD overall last year, especially because the oil has been weak. We've had CAD weakness. So as the oil has been weak, we've had CAD weakness. So against the dollar, you can see this is very much weakened a lot to the, moved a lot higher. So the dollar CAD has moved quite a lot higher. We've come into some pretty significant resistance points. This yearly high, as you can see, in 2004 at 1.4 really. And the next real level we're looking at is 1.431, which is these yearly lows here in 2000 and this yearly high in 1995. So we're coming into some pretty interesting levels. I wanted to point them out just in case we get there, because we've been moving very, very fast in this currency pair. If we do get up to these levels, pay attention to them. They could be some good risk-reward trades in them. And moving over to the Swiss franc, which actually has a very interesting structure. We've come off slightly recently, but the way this is structured now, the dollar versus the Swiss franc is actually looking very, very strong. Just technically, if you take a look on a very big time frame, you can see we've basically double bottomed here. This is a very big double bottom formation at this level of 0.736, and we're starting to potentially lift above this 1.024. If we get back above that hold, we're breaking this very, very big trend line that we've been holding literally since 2004, 2005. And if we can start holding these prices above this trend line, which at the minute we actually are doing, we've broken above it. We've seen some price action, some aggressive buying above that level, and now we've closed two monthly candles above it. Now, if we can start holding and getting back above here, I do think there's some really good upside in this this currency pair. Keep an eye on this Swizzy. It looks like it could be potentially setting up for a monster move to the upside if we get the impetus. So that's another currency pair I'm just taking a look at, and potentially a setup that could play out. Obviously, if we start breaking down below this trend line and trading back into this range, that setup would be null and void. That's without, I don't want to point the obvious out, but that is the obvious point I have to point out. And then the last but not least, one thing I wanted to point out before we move on to the equities is the dollar yen, which on the year has posted a doji, has actually failed to hold above the year's 2014's high, and closed back inside. It's a doji formation. It's actually showing quite a bit of weakness, and it's actually closed below this green trend line that you can see in here. And overall, this currency pair has had a lot of strength, or the yen has actually had a lot of weakness in recent time. So the dollar yen's been strong. But now we've seen just a small indication that this can be slightly exhausted in, at least in the short term. So the way this is now structured, if we take a look at the monthly chart, we're back below this very key 122 level, a level that we've been talking about time and time again in our roadmaps and wrap-ups. This potentially could be just a slight bit of a topping formation. You can see if we draw this little trend line, if we start breaking back below this level, there could be quite a few longs that need to cover aggressively to the downside. So the way this is structured, we've got a bearish engulfing monthly candle there. We're starting to move back down now. If we start getting some moves below, especially this 115.82, we might start seeing some continued flow to the downside. Keep an eye on this currency pair in the weeks, months, and year ahead. Now, let's just try and quickly shoot through these equities before we wrap up with some of these commodities. I know this is a much longer stream than I usually do. Much longer. But in any case, it's quite important to have a well-rounded look at what we're looking at, what we could see in the year ahead. If you don't do this prep in the beginning of the year, when are you going to do it effectively? So we've got first chart I want to take a look at is the stocks. So the Euro stocks, which is quite interesting, the Euro stocks 50 cash chart. The Euro stocks 50 cash looks quite interesting. If you can see, the high of all time is at 5,522. We had this really big downturn in 2000, another big rally up into 2008, our fall in 2008, or our descent in 2008. We've been trying really hard to make a move back up. In recent times, we've had QE, we've had in the US, we've had now with QE in Europe, and for a year where QE was launched. Now this is very interesting for me. This is the year European QE was launched. This is the candle. This is what we have to show for it. We've had a pretty big move to the upside, yes. Our yearly high at 3,880 and 3,836, with our low at 2,973. Yes, we've had a big move up to the upside, but our close has been fairly lackluster in my opinion. We've closed back below the yearly high of 2014. Now, if we can start making and breaching below these lows, now remember, since 2011, 2010, I'd say this is I'd say that low is probably from 2000 and this low is from 2012, 2011. Okay, so since literally 2011, we haven't taken out a yearly low yet. So this constitutes what we call one-time framing, or OTF as we call it. So we've got OTF in play. If we take out this low at 2,973, well, you know, we might actually start seeing some of these longs that have been really pressing for the European markets to move higher. You know, they've been really trying their hardest, but it's just not moving. If we get a low taken out here, well, potentially you might actually see, you know, one of these horrific candles to the downside now. It is a scenario. It's not. It doesn't mean it's going to happen. There's always the ECB there to backstop any sort of move like that. So remember, with central bank intervention, you can't really go too heavy on the short side. But you never know. This could potentially be a scenario, and it's something that I'm looking at. And that's why, like I said, I don't usually look at yearly charts, but the way this yearly chart's looking, it doesn't look all that healthy in my opinion. So that's the Euro Stoxx 50. Looking at the DAX, not much to talk about. That actually closed quite a bit higher relatively. If you take a look at the charts, it hasn't closed below the high of 2014. It's actually closed higher, as you can see there. We got up to 12,390. The previous all-time highs that we had well, this was in 2000 and this was in 2008, 2007. We're still above those levels, so I would keep that in mind. But we still have a very similar case where we've got that one time framing on the yearly 1, 2, 3, 4 years now where we haven't taken out a yearly low yet. So potentially if we take out that yearly low at 9,325, we could see a similar reaction to the downside. Nonetheless, this market actually looks quite bullish, so there's a bit of a contradiction there. But just keep in mind that could potentially be a setup that plays out in a year ahead. Looking really quickly at the FTSE, which actually, you know, compared to those markets that we showed, is actually looking very ominous. You can see the all-time high previously was here at 6,950. We took that out this year actually and made a high at 7,122. But given all the commodity weakness, the commodities have been very weak, and being as the FTSE has got a lot of miners, oil, energy companies, this has underperformed substantially, and we've seen a move up, a false break of those highs, and we've actually come back inside. This market, for me, actually looks bearish. So on a yearly time frame, this does not look healthy to me. This looks like it tried to move higher, it couldn't make a new high. It's even broken that previous yearly low there. You know, this doesn't have, you know, much structure to the downside, and if it really did want to start trucking, it could. You know, if it start taking out this yearly low at 5,776, you know, there could be potential for it to test as low as these lows as we made in 2010, 2011 at 4,791, which you can see is a nice little yearly double bottom low. You know, will it go and test that area? Potentially. We never know, but this is why we're looking at this chart right now. We want to pay attention to how this market's looking. Obviously, if we do take out this high, all those scenarios are null and void. Let's not forget that. Last equity market that I want to take a look at is the S&P 500. On a yearly time frame, this market has left a doji and actually has closed below the previous high in 2014. So you can see we tried to make some headway to the upside. We failed. we made a move to the downside, we came back up, and we've closed below the previous high on the yearly time frame. You know, given the way this is structured, this is probably has the most severe case of one time framing on a yearly time frame, I think, that you can point out. You know, ever since 2009, we've had 1, 2, 3, 4, 5, 6 years of one time framing set up in the S&P 500. This is a cash market as we're looking at right now. So really, what am I looking at this year? Well, let's just pull this out on a monthly. We know our level, we know our yearly low. Our yearly low comes in at 1,867, as you can see in here. If the market takes out this level, I'm going to be looking for trend moves to the downside, and there's no two ways about that, really. You know, people have played a heavy price trying to short this market in this massive rally that we've seen since 2009, but the Fed is now hiking rates. The market's known that. Yes, it's known that for quite a while, that it could potentially hike rates. It's now started hiking rates. I think in previous hiking cycles, the market's actually rallied throughout the time it's realized and it had to price in that the market, the Fed was going to hike rates. So really only after the Fed actually started hiking rates did the market start actually entering a bear market. So, you know, watch out, because if this thought actually starts trucking to the downside and taking out that yearly low, well, then maybe we might start seeing potentially some violent moves to the downside, as we saw in August 2015. Obviously, in terms of levels, I don't want to point out the obvious, but these two highs, as you can see, from 2000 and 2008 are obvious levels. That level at 1,576 was that previous all-time high. If we get there, I wouldn't suspect it to get there to the tick, but you know, anywhere within 20 to 50 ticks of that area is going to be pretty good for a buy, I suspect. If it actually gets to that level and you actually get to buy that level, if it gets there, you're probably wrong, in my opinion. You know, if it gets there, it's probably going to flush through by about 50 ticks. If it can't quite get there, then maybe you might get a rally. That's usually how these huge levels go. If it's too obvious, if it gets there and you get the trade, you're probably wrong. So just keep that in mind. And obviously I'm talking way in the future. This is not going to happen overnight. But if in the case we do get a massive sell-off this year, pay attention to that high. I mean, it's too obvious not to pay attention to. Right. That's how the market structured now for the S&P 500. Quickly looking at the commodities so we can wrap this baby up. They've been probably the biggest movers of 2014 and 2015. Firstly, I want to look at gold, which gold has had, you see on a monthly chart, you know, it's had a pretty hard time. It's been a pretty rough time since 2011, 2012. 2013 really. 2011, 2012 was pretty much in this range. We broke out to the downside in 2013. We had this violent move down, and we've been slowly just drifting down and making our way back down to these 2008 highs, which you can see. This pivot for me, and I mentioned this in my wrap-up at the very end of last year, this whole pivot area for me is looking pretty juicy. That's a horrible little box that I just drew there. But in any case, the levels that I'm looking at are 1,045 and 1,014. That whole area is definitely a low volume area. Very low volume traded there. You can see it hasn't done much volume. It hasn't done anything at all there, really. So that area is pretty interesting. If we can hold this area, you know, that could give us some impetus for a move back up. Obviously, if we can start filling this area in and doing volume, then we might have a chance to break back below into this region. You can see this area that we built since 2007 coming into 2009. A level that I'd like to point out just really quickly is a level that just a spike that we saw in the 80s, I believe. Yeah, 1980, we saw a very big spike in oil. That spike high is at 875. If we get to that level, potentially you might see a bit of support. So just keep an eye on that longer time frame move. Another thing to point out, we do have a bit of a falling wedge in this market, as you can see here. So really, you know, the best way to say to trade this, in my opinion, obviously it does look bearish, but I think the best falling wedge patterns are when you get a reversal. So when you actually get a break of this, let's say we start moving up, we get a break here, you usually get quite aggressive moves as all these shorts need to cover quite aggressively. And now moving on from what I just said, now very similar pattern we're starting to see is actually in oil. And in fact, in oil, I much prefer the way this is looking. Now, I don't want to be the one to be a bit of a contrarian, but obviously there's no reason to be bullish the oil market at the minute. In fact, you have to stay bearish the way it's trading at the minute. However, given the way the market's structured at the minute, there could be some hope for the bulls if we break this pattern. Now, this is looking a lot better than the last one. The other one was a little bit more, I'd say, a light version. You know, it is kind of converging, but it's more like a trend channel rather than a converging pennant type wedge. You could see this right here is looking a lot more like a falling wedge pattern. So we've got the move into it, falling wedge. If we can break this upper trend line, which now has 1, 2, 3, almost 4 touches, say 3 touches, which is good enough for me really. If we start breaking back above here, I think we might see an aggressive reversal to the upside. Remember, the way we're shaping up at the minute, we've got a lot of tensions building up in the Middle East, not only with ISIS and Syria. Now we're getting a little bit of destabilization in Saudi Arabia as well. They just murdered one of the key Shiite clerics, Al-Namir, I think his name was. I can't remember how to pronounce his name. In any case, the Sunnis now are the Shiites are very, very upset. And in Iran, they went nuts, started burning down the Saudi embassy. Now they're breaking up diplomatic relations with Iran. Saudis said that, Bahrain has said that, a few other countries are starting to say the same thing. So there's a lot of tensions building up, and you know, as we've seen in some of the other countries around the region, every time we see tensions like that building up, and especially within the country, so even within Saudi we're getting riots, which is something that, you know, we haven't really seen before. They've actually managed to keep things quite stable there. If Saudi Arabia actually starts becoming unstable, remember they're the biggest supplier of crude oil in the world. If these guys start beginning to destabilize, you know, the price of oil might actually shoot up more than anyone can imagine. You know, it's happened in other countries, but those countries such as Syria, they're not major exporters of crude. You know, when it happened in Libya, we did see oil rally occasionally on those events. You know, some of these other countries, especially when there's a situation involving Iran, but now it's Iran and Saudi Arabia. These countries make a difference to the global oil supply. If there's tensions, if a war breaks out between these two countries, oil, I can guarantee oil will not be trading where it is right now. You know, you know, I'll put my money down, obviously, on my trading desk more than anywhere else, that oil could potentially rally 10%, 20% on that kind of news if a war breaks out between these two countries. Now that's jumping the gun completely. You're saying, Milto, wait, where are you going with this? This is too much. But I'm just saying it's a scenario that could play out this year. If we see something like that, something big like that take place, don't be surprised if oil just completely snaps back and reverses all of what it lost in 2015. It could do that. You know, we've had these supply concerns, but if we get a supply concern from the other end now, we might get a short supply. Well, everything that's been priced in might have to unravel. So just keep in mind, potentially we might see a scenario like that. Obviously, the way it's structured, it's not saying it should reverse, but I'm saying it's a scenario. If it doesn't, what we want to be taking a look at is these lows here at 32.40. The low of last year is at 33.98, below 32.40, which is the low made in 2008. Really, there's not much to keep in mind except when we start getting a little bit lower. If we just scrunch this up a little bit more, you can see these highs here at 26.8. Pretty interesting little level in here. Around this area, you can see we've had closes, lows, highs in here. Pretty interesting little level. Obviously, below there is the low of this range between 1986 to 1999. It was at 1035. Obviously, that would mean that we've got a huge glut in supply, and China has completely collapsed. In that scenario, maybe we might start trading down to these levels. So keep in mind that could be a scenario as well. And we take a look now over at copper, which is the last one we're going to cover before I take off and go home. This is the copper market at the minute. Obviously, this hasn't had much attention. Dr. Copper hasn't had as much attention as oil this year, or gold, but bear in mind this has had a fairly big move. It's been flagging, breaking, continuously, literally just trending lower and lower. It hasn't really had any sort of significant support. Now we're holding above about the $2 mark in high-grade copper at the minute, but we do have on the monthly an inside month. Now if we do actually break this inside month, which has a low, let's see here, a low at 2025 and a high at 214, a break of that inside month, I'd say, to the downside could actually mean we start getting continued moves back down. Obviously, we still have quite a long way to go until we get down to these 2008 lows. But if we start trucking there as quickly as oil was trucking in 2015, this is going to start making headlines. And we're going to look no other than at China, because they're the biggest consumers of copper in the world, being such a big construction. They have such a big construction industry. Obviously, they've been on this massive leveraged move in building homes and building ghost towns that no one's living in, financed, debt financed, and they've obviously been using the copper to build these buildings. Now, if that slows down, which is there's no question in any analyst's mind or any trader's mind that there's a bubble in the property market there in China. If that starts slowing down rapidly, copper is going to be the one that's indicating that. It is already screaming out that there's a problem, but this could actually get a lot more violent, I'd suspect, where we might get moves that look a little bit more like this instead of like this. These little puny candles. We might start getting something a little bit more violent to the downside. Now, if that plays out, it's not going to be difficult to spot, but you have to be watching the market. You can't just wake up one day when everyone's looking at copper and look at copper. If copper's moving and it's affecting the market, you can tell before Bloomberg or CNBC tells you. You just have to look at a chart. And that's basically the moral of this whole story. We've taken a look at so many different charts. We've taken a look at so many different potential themes, but it's your job to keep in tune with each and every one of these markets and watch at what they're doing throughout the year to see how they play out. Because if you can continue watching them and build a picture in your head, you can start figuring out what the market's looking at. If you can just figure out what the theme is just for one day in a month. There's usually 1 or 2 days a month where there's a really strong theme playing out. If you can just figure out those days, but you have to be watching leading up into those days, when you figure out that it's actually playing out the way you thought it would play out, you can make a lot of money just on those days because you have watched it. You've been watching that, that plant grow throughout its lifetime. You know what it needs, what it needs to grow. You know what situations are going to help it grow, what's going to help it die, whatever. However you want to approach that metaphor. The whole point is make sure you understand how each and every one of these markets is moving and how it affects the main markets you're trading this year. And hopefully we'll all have a very profitable and prosperous new year in 2016 ahead. If you guys have any sort of questions, I know this has been a huge video for the year. But for those of you that did make it to the end, if you want to ask me any questions, I'm at MVS_Futex live. Hit me up on Twitter if you have any questions, or if you want to discuss any sort of things that I've talked about. Obviously, I've spoken about a bunch of different things. I'm sure there's going to be people that have their own opinions. I'm willing to discuss them. I'm willing for you to change my mind. That's what a market's there for. I'll argue my point up until I realize that your point's better. But at the end game is, I don't get paid to predict the future. I get paid to build scenarios, and from those scenarios, I can trade them accordingly when I see the right price action on my price ladder, when I see the market structure building up on my market profile, etc., etc. But like I said, hope we have a great year ahead, and we'll speak soon. Take care for now. Bye bye.